A warm welcome to you, my dear students. Welcome back again to Business and Accounting Studies. Well, we have come quite a long way up to this point. Now today we are going to start a new lesson, a special one. You might be wondering, what is the speciality today? Read the unit, the lesson. Yeah? Today we are going to start this lesson in your syllabus for the first time. You're going to learn about accounting. So children, today you're going to take a start, begin the learning of accounting in this subject, Business and Accounting Studies. Well, the subject title itself, says Business and Accounting Studies. So you're going to start to study accounting from this moment of time, from this session. So happy all around, right? Something very, very fun and something you will enjoy regarding our subject, that is accounting. Introduction to accounting. Today we are gonna take the basic fundamentals of accounting to introduce you, my dear children, to this subject or to this area of the subject. Right, introduction to accounting. In this unit number 4, these subtopics are to be discussed. Let's take a simple, not in detail, a simple breakdown of these subtopics that we have to study. First, I'm going to introduce you to accounting. Just like the main topic says, Introduction to Accounting. The first part of the lesson is an introduction. Second, objectives and need of accounting. Objectives and need of accounting. Right? Let's find out what are the objectives. What are the objectives, the aims of studying this part of the syllabus, studying this area of the subject. What is the objective? Why do we do it? Why should you learn this? Why should you learn this? Accounting. Let's find out. Every time we learn something new, I tell you that there should be a purpose. There should be an objective, a purpose, right? What is the purpose of studying about accounting? When it's about businesses, you have to learn accounting too. Why? We will learn. Third subtopic is business transactions. A simple thing, every business in this world, every business incurs transactions, or transactions occur in every business. We will find out what type of deals, activities are coming under transactions. Finally, we have 5 things. 5 things, children. Let me move to this side and I'll let you see it clearly. we have assets. Is it a new word to you? Maybe you haven't heard this word before. Maybe you have. Doesn't matter, we will learn. Then we have liabilities. Liabilities. Then we have equity. Equity. Fourth, we have incomes and we have expenses. I'm sure these two you already know, right? Incomes and expenses. But you're going to learn what assets are, what liabilities are, and what is the meaning of equity. What's equity? Then you're going to learn the connection between these concepts or these elements. The connection between these elements, right? What is the connection between these elements? You're going to learn that, especially that, and it's going to surprise you. Let's see. Right. Then it says something right at the bottom. It says something right here. It says, in this book, accounting refers to only financial accounting. Well, it must be something important, right? Otherwise, they wouldn't give you a sentence right on the cover page of the lesson. Well, they have given you something like this. It says, in this book, accounting is referred only to include financial accounting. How can I make this so short and understandable to you? Well, I will give you a very simple explanation. Listen, children. There are two main sectors or two main parts in accounting. Financial accounting and management accounting. Just remember those two. And in this level, in your O-level stage, you don't need, actually you are not expected to learn about management accounting. Okay? So, excluding that, the book has arranged this lesson, Introduction to Accounting and the other accounting lessons, considering only financial accounting. That's what it says here. Okay? There you go. We're going to move on and find out what is included in this lesson. First of all, you must learn what is accounting. You must have an idea in your heads, right? To explain or to define what is accounting. If somebody asks you, well, you are a child who is doing O-levels and you're studying about business and accounting, right? Business. What is a business? If somebody asks you that question. You're learning about business and accounting. Do you know what is a business? Yeah, what is a business? What are you going to say? I'm sure you know the answer. But if that person asks, all right, now you know quite a bit about businesses, but what's accounting then? What are you going to say? What is accounting? Let's find out. Children, accounting is a process. it is a process. It is a continuous process. It continues, which goes on until the business goes on. All right. It's a process which continues with the business. Okay. But what does it do? What does it do? What is the use of it for us as businessmen? What is the use of accounting? What is the use of accounting to a business? All right. That will be answered when we define accounting. What is accounting? Take this to your heads. Take it. It's a simple definition. Children, accounting is the process of providing financial information to the interested parties for their decision making. All right? Now, again, I'm going to repeat, you're going to take it to your heads very clearly. Accounting is the process of providing useful information to the interested parties in the business for their decision making. Okay? Now, I repeated and you heard it 2 times. I'm going to say it using different words. I'm going to make it simpler. Accounting is the process of providing information to the stakeholders of the business. Okay? To the stakeholders of the business. You already know who stakeholders are. In the previous lessons, we have discussed these things. We have learned about stakeholders many times. Okay? I'm not saying that you have learned about stakeholders once. No, not once. You have learned about stakeholders many times. And about many stakeholders, right? Internal stakeholders and external stakeholders. So I'm not going to explain who stakeholders are. Right? Fair enough. Accounting provides information to these stakeholders of the business. What for? Why? Why? Because they need to make decisions regarding the business or about the business. They need to make their decisions and they need to be updated regarding the situation, the condition of the business, the financial situation of the business. So we provide information to the stakeholders of the business for their decision making, and that is accounting. Simple, right? So I'm going to write the definition in this blank. It's in your textbook, children, but here I have made it easier, simpler. Okay? Accounting is the process of providing financial information. I'm going to make it red. I'm going to write this in red, or is it pink? Whatever, a different color. Financial information. Okay. providing financial information, right? I'm going to tell you why I made it using a different color. Providing financial information to the stakeholders. To the stakeholders. Without saying stakeholders, I can say interested parties. Whatever that is easy for you, you can use that word. Stakeholders, or you can say interested parties. The people, the parties who are having an interest about the business. Right? They can be internal, they can be external. We know these things, we have learned, right? Internal stakeholders and external stakeholders. Whoever having an interest on the business gets the information, the financial information about the business, right? For their decision making, to make their decisions. And providing that information, those information, is the process of accounting. Now, some children must be wondering, so where is the accounts? Where are the calculations? Where are the accounts? Where are the tables? Isn't accounting something? Isn't it something which involves a lot of accounts and tables and numbers and digits? And children sometimes ask these questions. You're gonna learn, you're gonna make these things very clear as we move on, right? I'm gonna make these things clear to you as we move on. So don't worry. Just remember, accounting is the process of providing financial information to the stakeholders for their decision making. For decision making. Okay, it goes on. Right? For decision making. Now, let's see, why is this process needed? Why is accounting important? What is the purpose? I already told you, we have already now come to an agreement, you and me, that accounting is a continuous process which continues. Okay, until the business goes on, accounting goes on, continuous process. Okay, and you must be wondering, why is it providing information, and to whom is it providing information? Are you wondering now? No, you're not wondering. You know to whom accounting provides information. It provides information to the stakeholders. Children, accounting is the language of a business. Accounting is the language of business, of a business. Accounting is the way a business communicates. So children, now you're going to find out what is the importance or what is the purpose of doing accounting by a business. Main objective is providing information. Main objective is providing financial information. Maybe you don't know what is financial information, so I'll just give you a brief explanation. Financial information simply means information regarding money, monetary transactions. So all the information which can be measured in money that happens in the business is recorded in accounts, analyzed to be useful for the stakeholders and provided to them. Okay, so the main objective becomes this, right? Main objective. We are moving down to sub-objectives. Sub. Sub-objectives. Other objectives. To know whether the business has made a profit. Like I told you, children, to provide financial information, when I said that, I also said financial situation of the business, financial position of the business, financial performance of the business. So when we say performance, is it a good performance or is it a bad performance? If it is a good performance, you are having a profit. You must be having good profits. If it's a bad performance, you are performing very bad in your finances. Right? As an owner, as a sole trader, you're very bad with your financing part, financial management. Then the performance of the business is bad, so you might end up with a loss. That is the performance of the business. If it's a good performance, if you are a good manager, if you are a good financial controller, transactions and the dealings regarding money, you are gonna end up with a profit. If you are a bad manager, bad financial controller, you are gonna end up with a loss. We will provide those information to you if you are the owner. Not only to you, to other stakeholders too, as accountants. Right? Providing financial information and letting you know whether the business has made a profit or a loss. Second objective. Third, determining the financial position of the business. Like I told you, position of the business, performance and position. Okay, two main very important things. Whether the business has made a profit. So, profit or a loss. So, profit or a loss. That becomes the performance of the business. Performance. And whether the position of the business, regarding the position of the business, we are providing information to you. We are providing to you. When I say we are accountants. We are providing information to you. When I say that, I refer to you as stakeholders. So accountants provide information to you, to stakeholders. You might be the owner of the business, you might be a manager, or you might be an external stakeholder such as a supplier. It doesn't matter. Right? Position. Financial performance, financial position. Okay? Right? Then there is another purpose of doing accounting, that is for legal requirements. That is for legal requirements. Which means for some businesses, children, for some businesses, it's a compulsory requirement, compulsory need to show their accounts. It's compulsory. Legal actions will be taken against your business if you do not provide your accounts, accounting records. For some businesses only, okay? So to fulfill that requirement, that need, that purpose, we are doing accounting. That is the third. First, second, third. For legal requirements. Last but not least, finally we have to avoid omissions, misunderstandings and frauds. Okay, there is a very slight mistake here. Misunderstandings, this is one word, okay? There's a space. Don't worry about it. Misunderstandings and omissions. Not only that, frauds. To avoid, to stop, to stop stakeholders, owners, managers, employees, and external parties such as suppliers, competitors, government, to stop them from misunderstanding the information or the position or the performance of the business. Stop them misunderstanding that. Okay, having misunderstandings. And to stop frauds from happening. You know what frauds are, right? Frauds are cheating. If you do not do your accounting properly, if you do not have your accounting records in an orderly manner, some people in the business might go through your ears. Like they will go through this year and come out of this year. You understand what I'm saying? People may misuse the business resources, especially money, if you do not have your financial records properly. So for that we do accounting, to stop frauds and cheatings and misunderstandings. Right. So children, here you go. What is accounting and why accounting is needed? At least memorize, take to your memory, keep in your memory at least three objectives, okay, with the main objective. The main objective is providing financial information to the stakeholders, okay, for their decision making. And you have these sub-objectives: to know the financial performance, that means profit or loss of the business, and to know the financial position of the business. These three is enough. If you can memorize these three. Will be useful for you. Moving on. What are transactions? What are transactions? Transactions. Okay. In Sinhala, when children are doing Sinhala medium, we say ganudenu. But in English medium, we say transactions. Okay? When I mention the Sinhala word, you may have already understood, right? It's simple. Transactions means ganudenu. In other words, exchanging of resources of the business with various parties. Exchanging. Okay, the resources of the business with various other parties. A simple definition. We'll write it down. Transactions means exchanging resources. When I say resources, you must understand, you must know, resources means money and other resources. Exchanging resources of the business with various parties. Various parties. Can be internal parties, can be external parties, various parties. You are exchanging resources. So exchanging resources like buying goods for money or selling goods for money. These kind of activities are all transactions. Paying an electricity bill with money in cash, paying a water bill in cash. Exchanging resources, children, exchanging resources. Those are transactions. Paying an employee's salary for the month, or paying for the insurance of the building, paying the insurance of the motor vehicle in money, in cash. All are exchanging resources, so all are transactions. Can you memorize this? It's a simple sentence. Right? Exchanging resources, money and other resources of the business with various parties. Okay? Transactions. In accounting, only those transactions which can be measured in monetary terms. Now that is something I have already told you. I told you about this. In accounting, only those transactions which can be measured in monetary terms. What is the meaning of monetary terms? Monetary terms. I will underline these three words. Only those transactions, okay, which can be measured in monetary terms. Few minutes ago I told you this. I explained you this. Information which can be measured in monetary terms means information which are money related. Information which can be measured in money. And in the previous slide, I gave you another word for that. I told you that means financial information. Information which can be measured in money means financial information. So we are providing financial information only, right? In accounting, we are considering financial information only, right? That's why here it says accounting, we take only transactions which are financial, which are measured in money. Okay, no other transactions are taken. Let's take some of the transactions which are non-monetary, which are non-financial transactions, okay, which we do not take to our accounts. Let's take some of those information, some of those transactions. The first transaction I took for an example, buying goods, buying a stock of goods, right? Buying a stock of goods which we need for our shop and paying in cash. Is that a financial transaction? Yes. Yes, it's a financial transaction. There is a monetary value. Let's say you bought a stock of groceries for your grocery shop, right? You bought biscuits from Malibu company. You bought chocolates from Richbury. You bought butter and margarine and cheese and other sweets. The entire stock is worth, let's say, 50,000. That is a monetary value. You see? So the transaction can be measured in money. Stock was purchased for 50,000. Monetary value can be measured in money. Second transaction I took was selling. You sold goods. You sold goods, stock of goods. Let's say you sold 10 kilos of rice and a milk powder, packet of milk powder. And that transaction, for selling those goods, you charged the customer, let's say, 1,500 rupees. That also is a financial transaction because there is a monetary value, can be measured in money. Financial transaction. You paid the electricity bill, 6,500 this month's or last month's electricity bill. You paid the bill in money, in cash. 6,500, that's a monetary value. That's a financial transaction. Likewise, children. Likewise. These transactions, that the transactions we take for accounting, we consider in accounting, should be monetary transactions or monetary information or financial information. What are the non-financial information? Why don't you tell me? Information which cannot be measured in money, which we do not have a monetary value. Can you think of something? Yeah, you. What did you say? Did I hear it right? Did you say the manager of the factory is 55 years old? That is also an important information, right? The manager of the factory is 55 years old. So that information is useful for the stakeholders. Let's say I'm the owner of that factory, of that business. That information is useful for me because he is 55 years old. In five more years, he is going to retire. So I should I should search for another manager. It's useful information, isn't it? It's useful, children. But it's not a financial information. It is not a monetary transaction. Or very simply, it does not have a monetary value. It cannot be measured in money. Those information also are important, but not for accounting. We don't take this information in accounting. Right, so that's that. Then transactions are divided into two main groups. Cash transactions, credit transactions. Cash transactions are transactions which happens then and there and in cash, for cash. Then and there payment is made, or the payment is received, or money is involved. Then and there, cash transactions. What examples can we give for cash transactions? Children, cash transactions. Yes, what did you say? Did you say, I didn't hear that. You should be able to think about cash transactions, children. Something that you do every day. Cash transactions. Now you should think not as customers. You should think as business owners from this point onwards. If you said going to the grocery and buying a chocolate, you are still considering you as a customer. From this point onwards, children, you should consider yourselves as the business or the accountant of the business. That's something that you should bear in mind. You should have that mindset from this point onwards. Otherwise, you are gonna have some trouble with the preparing of accounts. If you think of yourself, if you put yourself into the customer's position, you cannot do the accounts and the preparation of accounts of a business. You have to put yourself to the business. You picture yourself as the business or as the accountant of the business. You are an accountant. Okay? Can you do that? Can you? You must. Otherwise, preparing accounts will be a little confusing. I'll again ask you, what cash transactions can you think of? What did you say? No? You can't think? Can't think of any cash transactions? Again, maybe you are thinking yourself as a customer. No, let's think as the business. You picture yourself as the business or as the accountant of the business. Okay, and we'll come up with a transaction. Paying the building rent of the shop or showroom in cash. That's a cash transaction. Paying the electricity bill of the month in cash. That's a cash transaction. Settling the loan installment. You have taken a loan and you have to pay it back. This month's installment. Settling the loan installment by a check. That is also a cash transaction. By any means, whether you have paid in cash or whether you have paid by a check, by any means, the monetary value is then and there settled. That's cash transaction. Those are cash transactions. The monetary value or the transaction value is settled then and there. Children will consider 2-3 cash transactions and we'll move on. Paying the electricity bill. Paying the rent. Yeah. Settling the business loan or the loan installment. All are cash, done in cash, paid in cash, then and there. Cash transactions. Or receiving a check. Receiving a check from a customer. These are all cash transactions. Now let's take some examples for credit transactions. What credit transactions are, you might know. If you don't know, I'll just give you one word. I'll just explain credit transactions with one word. Naya. Nayata ganuden. In Sinhala we simply use those words. That's what is meant by credit transactions in English. So cash transactions, then and there, the monetary value or the money is paid or received. Cash transactions. Credit transactions means the monetary value, money is not paid then and there, or the money is not received. Naya, Ganu, Denu, or credit transactions. Oh, there is a slight mistake here. There. Transactions. Now it's correct. Transactions. Clear? Shall we think of some examples, children? When I say shall we, I'm expecting you to come up with the answers. Or you should think of the examples. Credit transactions. Some examples for credit transactions. Now again, if you said something like buying a home theater system from a showroom on credit or on easy payment without paying the full amount. If you said something like that, I'm gonna say no, children, no. Again, you're thinking about yourself or thinking yourself as a customer. You should think of yourself as the business or as the accountant of the business. So from the business point of view, can you give me one credit transaction? A credit transaction which happens in a business, which occurs in a business. What about selling a stock of goods? Selling a stock of goods on credit. How about that? Yeah, that's a credit transaction, right? Yeah. Another one. purchasing, on credit, that is also a credit transaction, purchasing on credit. The monetary value is not settled then and there, and the transaction is not settled, or the monetary value, the money, is not received then and there. It's not settled. You're going to get the money on a later date, or you're going to pay the money from the business. The money will be settled on a later date. So children, remember the two main types of transactions: cash and credit. Main elements of accounting. Now children, main parts or main elements. When we say main parts or main elements, you get an idea that accounting has subparts, or accounting is concerned with many things or many elements as a combination, and we need to be aware of all these things. That is right, actually. That is correct. Accounting is concerned with all these elements. How many do we have? We have 5. 5 main elements. Right? I'll move to this side so you can view it clearly. First we have assets, then capital, liabilities, income and expenses. 5 different things, or 5 elements can be identified to work with. We have to work with these things, right? When we are going on with the accounting process, we have to work with all these elements. All right. Now these words might be new to you, but don't worry, we are going to discuss from the first one until the 5th, one by one. First, we are going to take assets. Assets. How do you pronounce it? Assets. Is there a definition? Read with me. Every business has assets which are used in business activities. Is that a definition? No, that is not a definition. We'll come up with a definition, as we always do. Okay? Assets, children. Now, get this to your minds, get this to your heads. Right now, when I'm along with my words, when I say it, pay attention to your heads straight. Huh? Assets means all the resources which a business has, all the resources which your business use, all the resources which your business use in your business activities, day-to-day business activities. All right? Assets. Everything, every valuable thing, every resource that can be measured, the value can be measured, that has a value. Every property, machine, motor vehicle, furniture, equipment, every single thing, the land, the buildings, every single thing that your business uses in its day-to-day operations. Day-to-day operations are called assets. All right? So, shall we write it down? Using blue. Blue is good for assets. Every business has assets which are used in business activities. This is the definition. All right, definition. All the resources which are used by a business. Which are used by a business. There's more. Generated, these assets, these resources are generated as a result of a past transaction. Generated as a result of a past transaction. You already know what transactions are. Transactions are exchanging of resources between the business and various parties. So these assets have come to the business, they have been generated in the business as a result of a past transaction. Okay? There's more. There's more in this definition. Generated as a result of a past transaction. There's more. You have to memorize these definitions. It's long, but you have to memorize. Okay? Which brings economic benefits. Which brings economic benefits. There you go, full definition. Memorizing is up to you, children. It's up to you. Okay. Marks will be granted for a full definition as it is given here in the examination. Let's read out. All the resources which are used by a business, generated as a result of a past transaction, generated as a result of a past transaction, which brings economic benefits to the business. Definition of assets. All right, so hope it's clear to you. It is clear. There's not much of complexity here. I mean, it's not hard to understand. It's simple, but memorizing is up to you. Assets. Here you go. Now, just to make things more practical for you, what assets do you have in your father's business? What assets do you have in your father's business? What assets are used in that business on a day-to-day basis, every day running? Every day running of the business. What things, what valuable properties are used? Properties is not a good word. Let's say what valuable assets are used by your father's business, by your brothers, by your uncle's business, by your family business. What assets do they use? Children, there are lands, there are buildings, shops, showrooms, machineries, if it's a factory, motor vehicles, lorries, buses, vans, cars, motorbikes, delivery vehicles. Number of things. All are assets, all are valuable to the business, and they are used in the day-to-day business activities. They have been generated as a result of a past transaction, and they bring economic benefits to the business. Memorizing is up to you. Memorizing will bring you benefits. Will bring you benefits, not economic benefits, but examination benefits. All right, let's find out what characteristics assets have. Again, blue color. What characteristics do they have? Again, number 1. What do you think? Characteristics, features. How do I look? My features. What do you think of my features? Am I a big made, heavyweight person? Long hair? No. If somebody asks about me from somebody else, anyone would say, yes, that Prabhat sir is a slim, a small-made person, very pleasant. My characteristics. Okay. Likewise, sets have characteristics. Assets, commonly, if we take assets, what characteristics do they have? Starting with this. Let's take number 1 here. Okay. And number 2 here. And the number 3 we have space down here. Right? Assets, what characteristics do they have? Assets are generated. Assets are generated from a past transaction. Past transaction. First characteristic, they bring future economic benefits. Economic benefits, children. Economic benefits in terms of money. They earn us money. They are used by our business, and we use them, these assets, to earn money. So they bring us money. They help us earn money to the business. Okay. We don't just keep our assets for display. We don't just keep them, to just for the sake of having assets. We just don't keep them standing, doing nothing. We use them. Every business uses the assets they have. So they bring us economic benefits. Economic benefits. Right? In terms of money, they help, they support our earning process, the profit-making process. Benefits are economic. Do you get it? Get it, right? Simple to understand. They bring future economic benefits. Then they are controlled. Controlled or used by the business. So you have a few characteristics, features of assets. You have them in your textbook too. Try to memorize like 1 or 2. It will be useful. It will be useful for you, not for me. It will be useful for you in your examinations. Okay? Shall we move on? I have shown you some assets. These are the images I could find, all right, regarding business sets. Here you have a businessman a businessman standing right here. So he's having a very happy face, right? Why shouldn't he have? He should have a happy, a very happy appearance, or he should be in a happy mood. Look at the assets that the business is having. Maybe the business is a construction business. They have buildings, they have houses constructed, they have motor vehicles, and they have, excavators, the diggers, machineries such as excavators, and this type of concrete mixing machines or concrete blocks making machines. I don't know. It's a big machine. And in the office, they might be having computers and equipments, motor vehicles, machineries, furniture. Right. So these are all assets. And we are going to divide these assets. Again, we are going to divide these assets. Okay. Let's see how we can divide them. Assets are divided into two groups. Right? Assets are, again, we have divided into two groups. It's in your textbook. But this particular picture, this way, the textbook has not showed these images, but the division or the dividing has been shown in your textbooks too. I have included these images to make it even more clear to you. All right. Assets are divided, categorized as current assets, and children, you can see this. Why don't you tell me? You can see the screen, right? Current assets and non-current assets. Now you must be wondering, how do we divide assets? You should ask me this question. Sir, how did you divide the assets of the business into two groups? Considering what criteria? You should ask me. Yeah, I heard you. Children, I will explain it to you. Assets are divided into two groups as current assets and non-current assets, depending on the use of these assets. The criteria can be taken as the use of these assets or the time that the existing time period of the assets. Depending on that, we have divided into assets are divided into current and non-current assets. To tell you this in a very, very easy way, I'll use these words. Assets are divided into short-term and long-term assets, depending or considering the time period which the assets exist in the business. We have short-term assets. Short-term assets means current assets. Current assets means short-term assets. Can you see the screen? These assets. These assets exist in the business for less than 1 year. Sometimes a few days. Sometimes only a few days. Sometimes only one day. Sometimes only not even one day. Like cash. Children, can you see the very first current asset? It's cash. Very, very short-term asset. Okay? So remember, current assets means short term. Short-term assets. Less than 12 months. Hope you can see this. Less than 12 months. Alright. They exist for a very short period of time. Just like this. Just like cash. Just think of this asset, children, cash. Cash will be in the business today. Let's say an amount, let's take an amount. 50,000 will be in your locker or will be in your cashier today. Tomorrow, your father or the manager of the business, he will spend that cash to purchase goods or to pay a bill or to pay a salary of an employee. It's gone. You get it? Got it, right? Cash is a very short-term asset. It could be in your cashier, in your cash till right now, but it will be gone in another 10-15 minutes. It's a matter of minutes. Cash always, circulates. Cash is spent, paid out, and more cash could come into the business. And again, the existing cash will be paid out and more will be coming in. That's why I say these are very short-term assets or current assets. Current assets. The very first one, we know that cash. Cash. Accounts receivable. Another word to use for accounts receivables is debtors. The people who owe you, debtors. The people who owe you, or the people who owe a business. Debtors. They have to pay a certain amount of money to your business. They have, maybe purchased goods from your business and they have not paid the amount yet. You don't keep debtors for a long time. You call them, you inform them a date to pay. Quicker the better. Quicker they pay, it's better for you. It's better for the business, right? Otherwise, if they disappear, without paying, if they leave the country, if they leave the city, if they just, you give them more time, more risky will it be for you. So you collect those money or the amounts from the debtors as soon as possible. That's why these assets, these debtors are considered as short-term assets. So the second short-term assets are debtors. You must be wondering, why do we consider people who owe us as our assets? Is it ethical? Well, children, it's like this. If those people, if those customers owe you money, they have to pay that sum sooner or later. Okay? Until they pay that sum to you, they are your assets. Those monies, those amounts should come to you sooner or later. Until they pay the money that they owe you, their assets. Short term, right? Short term. Next we have inventory. Inventory means stock of goods. Stock of goods that you have. Stock. You have a stock today, the stock will be sold tomorrow. You have a stock today, the stock will be sold by the next week. It will be sold. You have a stock today in your shop, in your showroom. In a couple of weeks, all those goods will be sold. And new goods have come into the showroom. That stock which you have in the showroom, which you have in the shop, is a current asset. Okay? Valuable. It's a valuable asset to you. But short term. Will be gone or will be replaced by a new stock in a matter of weeks, in a matter of days. So stock is also a current asset. And we have things like short-term investments and prepaid expenses. We will learn about one by one. We will learn about these things. Right. Short-term assets are done. We are going to long-term assets. So I'm going to write on the screen here, long-term, long-term, right? Long-term assets. Long-term assets. They will be in your business for more than 1 year, maybe for 20 years, maybe for 30 years. It doesn't matter. More than 1 year. More than 1 year. Okay, more than 1 year. And they are also called fixed assets. Because they are fixed. They are fixed in the business. They don't move so quickly like these current assets. They don't move so quickly. So they are considered as fixed assets. How many examples do we have? 1. Cars and trucks means motor vehicles. Alright, motor vehicles. Motor vehicles are long-term assets, fixed assets. You don't just buy a lorry for transportation purposes and sell the lorry tomorrow. What is the point of buying the lorry? It's funny, right? When you buy a non-current asset, you buy it to keep. You buy it for good. You buy it, you get the non-current asset in order to keep it, not to sell it. Okay? Not to resell it. So if you have a, let's say, retail shop, or let's say you have a restaurant, these COVID pandemic season, you don't get customers walking into your restaurant. That means you must start delivery. To start delivery, you need delivery bikes or tricycles or whatever. Bikes are the best option. So you buy 2-3 bikes, scooties. Now, those scooties, those motorbikes, those motor vehicles are non-current assets or fixed assets. You get it, right? Fixed assets. Why do we call them fixed? They stay in the business for a long period of time. Okay, right. Going on, land is a fixed asset. Of course, land, if you buy a land, it stays in the business for good. You build a building on the land, and the land will be used until the business goes on, until the end of the business. Land is there. So, non-current or long-term fixed assets. Furniture, buildings, machineries. Okay, land and buildings most of the time come together. Land and buildings. You know, there's a land and you construct a building like this on the land. Okay, and the land is considered with the building. Fixed assets. Non-current assets, long term. Okay, children, what do you think? Did you get a good knowledge and understanding about assets? How assets are categorized? Depending on the use of the assets and the time frame, the time period. Depending on that, we divide as current and non-current. We have some pictures of non-current assets and current assets. I hope you like it, children. Non-current assets. What non-current assets do you see? What non-current assets do you see? The main non-current assets. Equipments. Sure, non-current. Of course, non-current. Vehicles. Fixtures and fittings, such as AC machines, projectors, shop shelves. Furniture. These are non-current. All non-current. All these are non-current. Long-term assets. They stay in the business for a long period of time. Maybe until the business runs to the end of the business, they will be used. All right. Check these: lands, machineries, buildings. The most valued assets could be lands and buildings. Okay. Then motor vehicles, fixtures and fittings, furniture, and office equipments. Office equipments such as computers and printers and so on and so forth. All these heavy long-term assets are non-current assets. Let's check out the current assets shown here. We have cash. Cash. Cash is a current asset, very quickly moving or changing, circulating. Cash doesn't sometimes, the cash that you have in the business, it doesn't sometimes remain in the business for a day even. The cash will be always, circulating. It's moving. So, current assets. Inventory or stock. Inventory or stock. Cash in bank. Cash in bank, which means the money which is in your accounts, your savings accounts, your current accounts, your business accounts, bank accounts. The money which is in the bank accounts. Cash in bank. And the debtors, as I told you, the debtors. Right? This guy should have money in his hand. Money, he's going to pay us, right? He should have money in his hands. Yeah. Hoping that we are going to get the money soon. Right, children. These are the assets of a business. Assets. Remember the definition. All the valuable resources, all the resources which are used in business activities, which has been generated as a result of a past transaction. Okay, and they bring economic benefits to the business. Used in business activities, they bring economic benefits, and they have been generated as a result of a past transaction. Assets is that. And the dividing or categorizing is easy to understand. Okay? Short, long. Short-term assets, current assets, long-term assets, non-current assets. So children, today you learned about what the accounting process means. What is accounting? Okay. The importance of accounting. Why accounting is necessary? Importance of accounting. Objectives of accounting. What is the purpose of doing accounting? What is the target? What we target or aim by doing accounting? What do we aim to accomplish? Finally, we talked about transactions, business transactions, cash and credit transactions, and finishing with the main elements of accounting. 5 main elements: assets, liabilities, capital, income, and expenses. Okay? Assets, liabilities, capital, income, and expenses. Out of these, we talked about assets and categorizing of assets. With that, children, we are going to end today's session. Introduction to Accounting, Unit 4. I hope to see you with the next chapters soon. Thank you.